how does a prudent portfolio look like in the second half of 2025?
So, of course, a prudent portfolio depends on which risk market you're in. If you're a pure conservative client or investor, you will have a very different portfolio allocation versus someone who's aggressive. But if somebody in the balanced approach, I think that right now we are looking at a mix of around 50-50, around that. So 50 in equities, 50 in fixed income. Now, the issue with a lot of investors right now is that they go on this hype. They look at S&P on a daily basis. They look at it going up how many points or going down how many points. And a majority of quite a large part of their allocation is just into equities. So I would say that take this opportunity to re-look at your portfolio. And if you have not really looked at how fixed income is important as a hedge against what you don't know, which is the unknown, then it's really time to sit down with an advisor to look into fixed income solutions.
Okay. Marty?
Hey, Francis, good to see you, and good morning.
Hey,
so 50-50 balanced portfolio, equities and fixed income. I mean, usually people talk about 60-40, right? So what you're talking about is less equities and more credit, but not necessarily U.S. credit. What are your main concerns there?
Yeah, certainly. I mean, if you look at the U.S. credit, it's also a fundamental. It's based on the U.S. govies, the government debt. And in the action right now, I mean, in the news flow, especially right now, we've been seeing more and more concerns about that. I mean, the big, beautiful bill, the 3 Bs, whether that will continue to move U.S. Into more debt. And by more debt, it means incrementally higher rate of growth of the debt. That is going to be right scary for U.S. govies. So I would say that, I mean, at the end of the day, of course, the world, a very big part of the fixed income world is still U.S.-based, hard currency-based, U.S.-based type of fixed income. You can't really get away from that. But I think this is also currently a good opportunity for us to look into emerging market debt as well, into some of the regional space. That is something that's usually or quite often neglected by investors, but it's time to look at some of the names there.
Okay, so let's talk about that then. And, you know, when we talk about diversifying away from something like, let's say, U.S. credit, right? Obviously, people have been loving German bunds. But in EM, especially EM Asia, where are you finding the best risk-reward?
Oh, well, the only comparison for comparison's sake is always we have much less in terms of the liquidity or in terms of the stock, if you look at EM Asia. But for one, actually, China is quite a big issue as well. Some of the regional ASEAN ones. I mean, Singapore has, but always a lot of people just complain about having lower yields. But at the end of the day, it's not comparing a higher yield or a lower yield from fixed income. The fixed income is mainly as an insurance, as a hedge for your portfolio against the unknown. So, yeah, look into the regional space in ASEAN. I think that's good as well.
And when it comes to China, I mean, what is the next catalyst? Because right at the beginning of April, when we're talking about the high level of tariffs and sell U.S. assets type of behavior, a lot of guests were very bullish about rather sort of contrarian thinking, but interestingly, they were talking about how China could really shine, but it didn't really do much so far. Is it Politburo meeting? Is it the outcome of trade negotiations, another deep seek that we need for China to go higher?
I acknowledge that there are a couple of catalysts, but after the catalyst came in, there was an initial surprise, positive surprise,
and then it seems to really ease off. Lasting.
Exactly, and it diffused again.
Yeah.
And one of the key reasons is because we do see investors holding on to China 3 to 4 years ago. And they suffered quite a lot. And any form of positive catalyst, they will take the opportunity to take profit. And that's exactly what we're seeing right now. And so it's not going to be, it seemingly isn't a strong catalyst for them to be a longer term, a more stronger cyclical type of positive push right now. I would say that it really depends on a collective amount. We need to get up the entire virtuous cycle. So it's got to be the government pushing continuously as well. I mean, the government has been pumping in quite a bit as well. The household equipment subsidies, subsidies for EV, but that has also created excess capacity because of, in Chinese, we call it the 内卷, and that's the competitiveness. So that has created the excess capacity problem, and that's why we have been seeing PPI, Producers Price Index, continue to be in a year-on-year deflation for many, many months already. So,
and Hong Kong is one of the winners so far this year in the region. Do you think Hong Kong is absorbing the bullish story of China and reflecting that? Because when it comes to investors in China, they're a little traumatized by what happened a few years ago.
I would say Hong Kong is a very good proxy to assess the strong fundamentals of Chinese companies that are listed over here. And Hong Kong has got the liquidity and the history in the financial hub and the wealth management hub. So Hong Kong, I would say that right now is being lifted by the rising tide. Hong Kong is a boat lifted by the rising tide of Chinese fundamentals. I mean, if you look at it, offshore investors, foreign investors love to have a proxy to the Chinese fundamentals. I think through Hong Kong, that should be what we are going to see. And this is probably still the start.